Alberta heats extensively with natural gas, there was subsidies which amounted to $3.7 billion over that decade. So Alberta has spent a lot of its natural resource revenues on government operating and capital expenditures and tax relief. We have low taxes, the only province that doesn't have a sales tax, for example. There's a certain amount of money that has gone into savings of various kinds. Some people say that, well, we've used revenue to repay debt. There's been some direct subsidies. There's been cash disbursements to citizens. We've had quite a variety of things that we've tried. So what all during the course of this time has happened to the Heritage Savings Trust Fund? Well, if we look at it in real dollars per capita, in 2012 dollars, in the early 80s, the Heritage Savings Trust Fund amounted to about $11,000 per capita. Currently, it has a value of about $3,800 per capita, so about a third of what it was at its peak. In addition, one of the interesting features is that in the past decade, essentially in this past decade, the per capita value of the Heritage Savings Trust Fund was less than what it was in the initial year that it was established. So it's shrunk to a shadow of its former self. If you also look at it in the context of how much does it contribute towards the provincial government budget, when we initially began taking the income of the fund and using it in the general revenue, it amounted to 12 to 14% of provincial program expenditures, and currently it's running around about 3%. So it makes a much smaller contribution to the provincial budget than it did. The Sustainability Fund, well, this has got lots of lines. Let me just tell you the story. The Sustainability Fund was very effective at sopping up a lot of excess cash in the early part of 2000 up until 2008. And that was great. That was exactly what it was supposed to do. The recession hit, prices dropped, and the fund was used to sustain provincial government expenditures. A lot of it went into infrastructure expenditure, and it was very effective at maintaining expenditures and also supporting the Alberta economy. But then the Alberta economy recovered quite quickly and quite effectively, but we still continue to spend out of the Sustainability Fund. So it appears that what we're doing is that we're using the Sustainability Fund not only in bad times, but also in good times, and that's about to come to an end. No need to pay any attention right now to this top line, but let's look at this. This is natural resource revenues, provincial government natural resource revenues as a percentage of personal income. That's so we can kind of get a sense of how big is it relative to the economy. Okay, so in the early 80s, end of the 70s, early 80s here, it's over 20% of personal income, the equivalent of 20% of personal income. That dropped down to about 5%. Even in the last boom, it only averaged about 7 to 8%, and currently it's back at 5% or even a little less. So it's becoming quite a bit smaller than it ever was, certainly early on and recently. This graph really summarizes what changes have occurred in Alberta's use of natural resource revenues. It only goes back to 1981 because that's when the provincial government provides nice, consistent data over this period. But the top line is provincial program expenditures as a percentage of personal income, and the red line is non-natural resource own source revenue. Okay, that's a big term. What this is taxes, charges and fees, investment income, okay? Not natural resource revenue. So the wedge between these two is essentially made up of natural resource revenues or sometimes borrowing, okay? But basically natural resource revenues. So in this period, in the up until the early 90s, high levels of expenditure. Alberta was spending per capita 50% more than any other province in the country, and it had low taxes. Then that didn't work out too well because the revenues didn't keep up with the expenditures, so there was a substantial adjustment here, and we came down to where we were spending essentially the same as other provinces. We're spending basically the per capita amount of most of the other provinces, but what has happened is that we've taken the natural resource revenues as tax cuts, and those have been that has been declining steadily since 2000. Lower income taxes and personal, corporate income taxes, lower property taxes, fees and charges not keeping up with price change. And I don't have to pay attention to that. Okay, there's been some other ideas in terms of how we might use resource revenues. As Scott mentioned, we talked about dividends. A couple of us suggested dividends early on in a publication in 1980 from the conference he mentioned. That didn't materialize. I suggested a pension plan. You could, if we'd saved not all of the resource revenues, but just a modest fraction of the resource revenues, you could have had a pension plan that was for Albertans that was comparable to the Canada pension plan. And then the Canada, and neither of these have got any attention to speak of from the politicians. The Canada West Foundations suggested saving 50% and had a variety of things. Interestingly here, my colleagues Stuart Landon and Connie Smith have suggested for a stabilization fund that what they did was to look at a variety of what you might call stabilization funds. And the one that they found that was welfare enhancing, or the most welfare enhancing, was the one where you deposited 50% of natural resource revenues into the fund, and you took out 25% each year. So you contributed half, you took out a quarter. And this, if you model that on the Alberta revenue pattern over since the 1970s, is the one that provides, welfare maximization. Okay, so this is a set of interesting papers. If you're interested in stabilization funds, I recommend you look at those. What has the provincial government done? Well, it transformed the Alberta Heritage Savings Trust Fund from what I described initially to a purely investment fund aimed at maximizing financial returns. Then there was a financial management commission that resulted in the introduction of the sustainability fund. Only took us 30 years to figure out that resource revenues were volatile and we might want to have a stabilization fund. Then there was a commission, another commission in 2008 recommended increased savings again. Premier's Council in 2011 again recommended increased savings and using those savings for transformative investments. That is not necessarily those offering financial returns, but much like the original Heritage Saving Trust Fund mandate, would be used to change the economy and make it less dependent on natural resource revenues. Back to the future kind of thing. Okay? And then finally, this year's budget, the plan that came out of that is that since the sustainability fund is essentially depleted, we would call it a contingency account and we would try to restore that to $5 billion. All of the revenue that is generated within the Heritage Trust Fund would be retained by the fund within 3 years. And we could deposit up to 50% of natural resource revenues in the Heritage Savings Trust Fund, depending upon the level of resource revenues, but the The objective is a 50% savings rate. And interestingly enough, nobody has asked the question of what would you use that savings for? So, after 40 years, Alberta's natural resource revenue utilization policy remains a work in progress. We're still groping for a policy. Thank you.
I'm exhausted. Our final speaker today is Gregg Erickson, editor, I think I can say Emeritus, on the Alaska Budget Report. Born and raised in Alaska, he's one of the few people who know what Alaska was like before big oil. And he's been an observer and active participant in state policies regarding the petroleum industry and petroleum wealth management, at least since the famous Prudhoe Bay State of Alaska lease sale in 1969. Gregg was educated at Wesleyan University, University of Alaska, and began his professional career as a resource economist with the University of Alaska's Institute of Social, Economic, and Government Research in the 1960s. From there, he went on to Resources for the Future and the U.S. Senate Energy Committee, but returned to Alaska in 1976 to become director of the Office of Legislative Research, and later to work in the Office of the Governor. After leading the state's Exxon Valdez oil spill impact assessment and restoration efforts, he started the Alaska Budget Report, as well as his own economic consulting firm. Gregg has a long-standing interest in the history and economics of resource-based basic income grants, and is the author of 3 chapters in the recent 2-volume series entitled Alaska's Permanent Fund Dividend, Examining Its Suitability as a Model. Gregg is also a long time affiliation with the Robert Schockenbach Foundation and has served on its board since 2000. The mission of the foundation is to promote public awareness of the social philosophy of Henry George through distributions of his works and scholarly research on his principles as they relate to current events. Gregg, it's all yours.
Thank you, Scott, for that flattering introduction. I noticed that earlier in one of the earlier sessions that there were a majority of people attending from out of state. Could I ask you, those of you who are not from Alaska, to raise your hand right now? And I'd say it looks like a majority of people here too. Alaska is a place of paradoxes. And if you look around you in the room to the Alaskans around you, the Alaskan economists, most of them, a few politicians scattered around, but they probably have the same issue too. Stare intently at them for a moment, and you'll notice that they have tremor of the hand, perhaps blinking in an erratic manner of one eye, or Scott, I think, is jiggling his foot. These are overt signs of deep-seated angst, because despite the $60 billion of net assets, $70,000 or so per capita, and its AAA bond rating, Alaska is seen as having a precarious economy, and Scott's work recently suggests that half of the economy is dependent on oil, either directly or through government recycling of oil money. And the economists, rightly or wrongly, are worried about the extreme belt tightening, and politicians too, that they think might be in the future when our oil runs out or oil prices drop again. We've had experience with it, just like the other jurisdictions. If you look at the chart of Alaska's oil revenue, it follows roughly the same lines as Norway and Alberta. So let's start. probably a better title for my remarks is Where the Oil Money Went. It is interesting that, as far as I know, no one has actually really gone back and figured it all out. But given the angst that we have, it's also interesting that in 1974, about the time that the Prudhoe Bay pipeline was, or Trans-Alaska Pipeline was getting started, construction, an economist by the name of Robert Solow developed the first parts of a theory of how to manage natural resource wealth. He published the paper. The title was Intergenerational Equity and Natural, and Exhaustible Resources. But, and he won the Nobel Prize for that work, in fact. But it wasn't until 1977 that an obscure Canadian economist by the name of John Hitchcock worked it all out. And Hitchcock didn't win the Nobel Prize, but he got the rule named after him. It's called Hitchcock's Rule, and it's blindingly simple. Oh, wrong direction. And this is a direct quote from that 1977 paper. Invest all profits or rents from exhaustible resources in reproducible capital. Now, we'll come back to what he means by reproducible capital there, or what I think should be meant by it. But the rule has a very simple corollary too, although he didn't write it. To the extent that rents are diverted to consumption, future generations were going to have to cut back their, they're going to have to tighten their belts, and they'll suffer. So, what do we mean when we talk about consumption and investment? Well, back in the 70s, there weren't anything known as sovereign wealth funds, or at least they weren't known as such until then. Alaska established its fund in '77, and Alberta also in the 70s, I believe. And but any entity, any household, any individual who has to deploy wealth or income has these options available. It can be consumed, or it can be invested. And by invested, you can invest it in real productive assets. In the case of the state of Alaska, these are bridges and harbors and airports and power plants and all those tangible things that government supplies and that produce investable returns. Invested in intangible productive assets, and by that I mean human capital, education, and Alaska invests a great deal in education, far more than any other state in terms of a per capita basis. And it, or at least there may be one state that invests more than we do, but only one. In terms of the university expenditures for higher education, we're absolutely #1, both on a per capita and a per student basis. Or you can invest in financial assets, like the permanent fund, and those can be of two categories, depending on their purpose. One is rainy day funds, which of course we have in the Constitutional Budget Reserve, with about, I guess, $17 billion in there now, and a few other endowments and similar funds. Or a live off the income fund, rentier society, in which you don't put it into tangible assets, you put it into financial assets and then live off the income. Well, how did Alaska do? What did Alaska do? There is the cumulative financial flows of Alaska's oil revenue from 1977 through 2010. These are in nominal dollars, but, and we start at the top with, let's see, how do I get the pointer to work here? Scott, how do you get that? Don't know, huh? Show me how here.
Yeah, Professor. Well, I got a fat finger, so I hit.
Okay, great. Yeah, the 103, notice the tremor in my hand. The number 103 billion is the cumulative financial rents that Alaska has collected. Let's jump down here and notice that over the whole period it was only 15 billion that was collected from other sources. So virtually all of the government's expenditures, at least 85%, have been from oil rents. We skimmed off 11.8 billion over that period and put it in the permanent fund, and 7.2 billion, which was put into the rainy day fund. Of that, let's jump down then to the two funds. The Constitutional Budget Reserve, when I was working for government, was basically in deficit, but just as in Alberta, they built it up since then, or at least Alberta's intending to build it up. And the flows in and out of the CBR are exactly equal, which indicates that the legislature has paid back everything that it essentially took from the rainy day fund for stabilization purposes. Over here on the permanent fund side, we have, in addition to the almost 12 billion that went in from oil revenues directly, the almost 13 billion in inflation proofing, and about 7 billion of legislative appropriations. Most of that 7 billion came out of the permanent fund's earnings reserve, and we'll get back to that in a moment. But actually 2.7 billion of it actually came from the general fund by appropriation. The legislature hasn't done any of that for a long time, but back in the 80s and early 90s, there was a willingness by the legislature, a remarkable willingness to move that money off limits and put it in the constitutionally protected permanent fund. You notice that the earnings on the permanent fund have totaled 35 billion, but we've only paid out 18 billion in dividends. Well, that means over time, this earnings reserve has gotten bigger and bigger. And it is available for appropriation. And interestingly enough, there were a couple of times, most recently in 2008, when the earnings reserve was just about depleted. In fact, it was depleted, and only by some accounting ledger domain that was the state able to pay dividends and inflation proofing. So it's been up and down, and it is sort of serves as a stabilization fund, and there's an interesting formula that determines the size of the PFD, and I think we're stuck with that for quite a while. So those are the flows. Now let's look at a pie chart that shows where all that money went. And let's start with consumption. 38%, about maybe just over 38 billion, almost 40 billion, went to consumption of government services. 10% went into rainy day savings. The Constitutional Budget Reserve, Budget Fund, the Statutory Budget Reserve, and other similar funds. I can't see what the number is there, but that percentage, 12% went into the permanent fund, and investment took 33%, divided about 15% to infrastructure and similar kinds of tangible investments, and this 18% to human capital, intangible investments, and education. So, in a way, you look at this pie chart, the decisions about, and these were not decisions that were made on the basis of any formula. They were ad hoc decisions made at the time. But as you see, the state of Alaska diversified its use of this money and put a chunk in every possible, of all the possible slots. And perhaps that wasn't consciously thought about, but that's what happened. And but with the dependence of the state government on fiscal dependence on oil revenue, there is a tendency to see the issues for Alaska as matters of a fiscal crisis. And people talk about the fiscal cliff that the state is headed towards. And of course, with all those savings stashed away, the cliff can be put off for a long time, but it's still there. And the resource is non-renewable in a fundamental way and is depleting, notwithstanding the fact that technology can expand the margins. But I view the issue far more as an economic one. Alaska has plenty of resources, I mean, totally untaxed domestic tax base, basically, to supply itself with the kind of government that it is willing to pay for. But there could be some major, major adjustments. I don't see it particularly as a fiscal crisis so much as an economic one. And insofar as we have used the permanent fund to be a live off the income kind of investment, there will be opportunities for sustaining the economic viability of Alaska through those kinds of transfers. But as I have pointed out in a 1997 paper, which advocated privatization of the permanent fund really into an endowment with every current Alaskan as a beneficiary, almost practically no one in Alaska has told me they support that. But I still think it's a good idea, and I argue with Scott about it regularly, I guess. It seems to me that the world is not a better place because there are, say, I mean, nobody knows, nobody's done the analysis of how many additional people there are living in Alaska because of the permanent fund, because of the way we've decided to deploy the assets of the permanent fund in dividends. My estimate, very back of the envelope estimate, which I did back in 97, was that there were then about 60,000 people in Alaska who, whether they knew it or not, were here because of the permanent fund dividend. I'm sure that number is much, much larger now. I wouldn't be surprised if it's as much as a fifth of the population is here in one way or another because of the dividend. Is the world a better off place because of that? I don't think so. In fact, you can argue from economic theoretical grounds that it's a worse off place because people would be more productive if they were not influenced by this kind of issue, this kind of migration incentive or economic stimulus. Another big issue is when you're in an open economy, as Alaska is, very open. If you invest in education, you're investing in intangible human assets, human capital. But that human capital has, particularly the well-educated Alaskans, have very little attachment to Alaska. If times go bad here, or even if they don't go bad, people leave Alaska and they take that human capital with them, and that doesn't do much good for the politicians to see that putting money into something that then migrates away. The infrastructure in Alaska, of course, has I think, by and large, been productive, but there are a wonderful litany of white elephant investments, starting under Governor Hammond with the Delta Barley project, where for those of you who don't know about it, it was a wonderful idea. We were going to have agricultural community up there in the center of Alaska, and the agronomists told us the barley was going to just grow wonderfully, and there was a good market for it worldwide. We had a railroad that could take it to ports, and it turned out that the wild buffalo just loved the barley, and so they had to put fences all around the barley fields, and long story short, it turned out to be a famously poor investment. And we've had a lot of those. A huge seafood marketing facility at the Anchorage International Airport. You can drive by the building now. I think it's empty. It's a church now. A mega church, right? And, but despite those poster children for bad decisions, I think by and large the infrastructure has served its purpose and has not been I think most of it's worked well, but it is. I think we'll talk more about that at the session on Wednesday, and I hope, Scott, you'll promote that, because it's off-site here. It's not going to be here at the hotel, but I think we will have a very stimulating discussion about what could and should be done with the oil revenue in the future. And I see I've got just under 2 minutes left. I'll leave that for questions or for whatever Scott wants to use the time for. Thank you.
Thank you, Greg. And now it's time to open up to the audience for questions from our presenters. And while you're coming up to the microphone, I'm going to take my prerogative to ask the first question of Professor McMillan. You gave us a long litany of things that Alberta has tried over the years, experiments, and what you didn't say was whether you thought that method of sort of not having a method, not having a rule in place like Alaska with its permanent fund or Norway with its petroleum pension fund, but just a series of sort of ad hoc policies, whether in retrospect you thought that has worked out, or what you would have liked to have seen differently, sort of going back to 1980 and the advocacy of a permanent fund dividend.
I thought I could leave that one open, but but anyway, okay, you've asked the question. I am hard